About 2 months ago, I started seriously questioning something that, at first glance, seems almost unquestionable. Everywhere you look, the narrative is overwhelmingly positive. Inflation is cooling faster than expected. Wages are climbing. GDP continues to expand. Unemployment is sitting near historic lows. And the stock market? It's not just doing well. It's hitting record highs again and again, pushing into territory we've never seen before. By every traditional metric, the system appears not just stable, but thriving. And yet, there's this strange, persistent feeling that something doesn't line up. Because if the economy is truly as strong as the data suggests, why do so many people feel like they're falling behind? Why does it feel like financial pressure hasn't gone away, but in many cases has actually intensified? Why are everyday expenses still a constant source of stress, even as headlines celebrate economic strength? That contradiction is the starting point. And the deeper you go, the clearer it becomes that this isn't a temporary mismatch or a perception problem. It's structural. What we're actually living through right now is the emergence of two parallel economies, two systems that operate side by side, but follow entirely different rules. And depending on where you sit within that structure, your reality can look completely different. To really understand this, you have to separate concepts that most people treat as interchangeable. The first is the economy, and the second is the stock market. These are often talked about as if they're the same thing, but they're not even close. The economy is supposed to measure real-world activity. It's about production, labor, consumption, and trade. It's reflected in metrics like GDP, inflation, employment rates, and consumer spending. These numbers attempt to capture how people are actually living, what they earn, what they spend, and how they participate in the system. The stock market, on the other hand, is something entirely different. It's not a reflection of current conditions. It's a pricing mechanism for expectations about the future. Investors are constantly making bets about how much companies will earn years from now. Prices move based on forecasts, sentiment, liquidity, and positioning, not necessarily on what's happening in the real economy today. And there's another critical detail that often gets overlooked. The stock market only represents a tiny fraction of the broader economy. The S&P 500, for example, tracks about 500 of the largest publicly traded companies. Meanwhile, there are tens of millions of businesses operating across the country, small businesses, local services, independent operators, that aren't represented at all. So when people point to rising stock prices as evidence that everything is doing great, they're really talking about a very narrow slice of economic activity, one that is heavily concentrated, highly financialized, and deeply influenced by global capital flows. This disconnect between markets and reality isn't new. In fact, history has shown us repeatedly what happens when these two systems drift too far apart. Take the 1920s. On the surface, it was an era of extraordinary growth. The economy was expanding, unemployment was low, and stock prices were skyrocketing. It was called the Roaring Twenties for a reason. But underneath that optimism, there were cracks forming, massive debt accumulation, overproduction, and speculative excess fueled by borrowed money. Eventually, the system couldn't sustain itself. The market collapsed in 1929, wiping out enormous amounts of wealth and triggering the Great Depression. What followed wasn't just a market correction, it was a full-scale economic breakdown. But here's something that doesn't get enough attention. The stock market began recovering years before everyday life did. By the mid-1930s, markets had rebounded significantly. Yet millions of people were still struggling, unemployed, underpaid, or dependent on basic relief. The recovery in financial markets didn't immediately translate into recovery for the broader population. That pattern, markets recovering faster than people, has repeated itself in different forms ever since. Now fast forward to today. The divergence is back, but it's being driven by new forces. One of the most significant is the explosion of capital investment in advanced technologies, particularly artificial intelligence. Major corporations are pouring hundreds of billions of dollars into infrastructure, data centers, specialized chips, cloud computing systems. This spending fuels massive optimism in financial markets, driving valuations higher and higher. But here's the catch. Much of that investment doesn't directly benefit the domestic economy in the short term. Supply chains are global. Manufacturing is often outsourced. The economic impact, at least initially, is limited. So you end up with a situation where stock prices surge based on future potential, while present-day economic conditions for many people remain largely unchanged. And that's just one layer. The deeper force shaping everything is monetary policy, specifically, how central banks have managed crises over the past 2 decades. After the 2008 financial collapse, policymakers introduced unprecedented measures to stabilize the system. Interest rates were slashed to near zero. Massive amounts of liquidity were injected into financial markets. This wasn't just a temporary fix, it fundamentally changed how the system operates. By increasing the money supply and directing it into financial markets, asset prices began to rise rapidly. Stocks, real estate, and other investments all surged. But that growth wasn't evenly distributed. It disproportionately benefited those who already owned assets. Over time, this created a powerful feedback loop. As asset prices increased, investors felt wealthier. That perceived wealth led to more spending and investment, which supported economic growth. That growth, in turn, reinforced market optimism, attracting even more capital. And whenever the system showed signs of slowing down, more liquidity was introduced to keep it going. This cycle has now become deeply embedded in the system. It's no longer just a response to crises. It's a core feature of how the economy functions. The problem is that this loop is incredibly difficult to stop. Any attempt to reduce liquidity or normalize policy risks destabilizing markets. And because markets have become so central to economic perception and political success, there's enormous pressure to keep the system running. Within this structure, incentives matter more than ever. Corporate executives are often compensated with stock-based rewards, meaning their personal wealth is tied directly to share prices. This creates a strong incentive to focus on strategies that boost valuations, sometimes at the expense of long-term investment in workers or operations. Large asset managers, which control trillions of dollars, also benefit from rising markets. Their fees are typically based on the total value of assets under management. So as markets grow, their revenue grows automatically. And then there's the political layer. Market performance has effectively become a scoreboard for leadership. Rising markets are presented as proof of success. Falling markets are seen as failure. This creates a powerful alignment between policymakers and financial markets, one that reinforces the system rather than challenges it. All of this leads to a critical outcome: the concentration of economic gains. Data increasingly shows that a relatively small segment of the population, primarily higher-income households, drives a disproportionate share of spending. These households benefit the most from rising asset prices, which increases their purchasing power. Meanwhile, the majority of people are experiencing something very different. For them, income growth often barely keeps up with rising costs. Housing, healthcare, education, and everyday expenses continue to climb, limiting financial flexibility. This divergence is now shaping how businesses operate. Companies are adjusting their strategies to focus more on higher-income consumers. Premium products, luxury experiences, and high-margin services are expanding. At the same time, lower-cost options are becoming less viable or less prioritized. This creates a split across industries, a kind of economic bifurcation where growth happens at the top, while the rest struggles to keep pace. Economists sometimes describe this as a K-shaped economy. One line goes up, representing those who benefit from asset growth. The other line goes down or stays flat, representing those who rely primarily on wages. And here's the key insight. This divide is not just about income. It's about ownership. Because in this system, ownership of assets is what determines whether you move with the upward trend or get left behind. Income alone, even high income, is no longer a guarantee of financial security. Without ownership, it becomes increasingly difficult to build long-term stability. Even among high earners, this reality is becoming more visible. Many people with substantial salaries still report feeling financially stretched. Rising costs, lifestyle pressures, and lack of asset growth all contribute to that feeling. So what we're left with is a system where traditional indicators no longer tell the full story. The economy can look strong on paper, while large portions of the population feel disconnected from that strength. Markets can rise even as everyday financial stress increases. Growth can be real, but unevenly distributed. And that's the core of the issue. This isn't just a temporary phase or a cyclical fluctuation. It's the result of structural changes in how the system operates, changes that have been building for decades. Understanding that doesn't immediately solve the problem, but it does change how you see it. Because once you recognize that there are two economies, not one, you start to understand why the same data can produce completely different realities. And more importantly, you start to see what actually matters in navigating that system. Not just how much you earn, but what you own. Not just whether the economy is growing, but who that growth is really for. And until those questions become part of the broader conversation, the gap between perception and reality will continue to widen, quietly, persistently, and structurally shaping the future of the entire system.